Yes, review and finalization of audit. Student, review means when audit is substantives have been performed, actually there is two types of review. One is called overall review. The other is called specific reviews. Specific reviews of subsequent events is done here. And then here, going concern review is done. Okay, at this stage. So overall review is here. That now at this stage, it is the third stage where auditor performs analytical procedure once again. What is the purpose of performing analytical procedure over here? What the purpose is? The purpose is that auditor have now gone through the financial statements. He has or she has audited the financial statements in detail already. And now at this stage, auditor wants to check that what is my actual perception about the company based on my audit work, and now what financial statements are showing. One perception is which I formed during my audit of financial statements during the whole year, or 4, 5, 6 months, which the perception I had about company. And now what financial statements are showing, whether it is consistent with my knowledge. What is in the books and what I have seen, that is consistent or not. This is the purpose. And whether financial statements, auditor has to check financial statements are as per laws and regulations or not. Financial statements are as per laws and regulations or not. Yes. Next, then whether they are as per accounting standards, accounting policies, they are consistently being applied or not. And very important at this stage, this stage logically comes before audit report. But I have taught you people audit report first. So there was a technical reason, because audit report terminology has to be utilized over here. So the accounting policies, the aggregate uncorrected misstatements, that is material or pervasive or not, so that we can decide later on the type of audit opinion to be given if management does not correct that. And then audit completion checklist, auditor has checklist, tick tick tick, work is done which was planned or not. And then clearance meeting with the management, some issues are resolved, some things are clarified, and of course the final closing meeting it held. This is called overall review. Now comes the specific reviews. Now, specific review is the first thing is subsequent events. Subsequent events have another name. They're very interesting. Events after the reporting date. What is the reporting date? Reporting date is date at year end. Yes. Subsequent events. Events after that. For example, year end is 30th June. For example. So what are the subsequent events? We need to know the definition first. Focus, everyone. So then subsequent events are basically, come here. Let us draw it. This is year end date. Okay. Then this is financial statements are published. Prepared. Then is audit report is prepared by auditor. Then here financial statements are published. And here is AGM. And at AGM, financial statements are approved or adopted by shareholders. Now, this is the timeline in front of you. Students, focus, everyone. Focus, everyone. Subsequent events are those events which events occurring during this time. Events occurring during this time. One thing, and facts discovered, not discovered, which come to knowledge of auditor. Auditor is not looking for anything, but during this period of time, some facts come to the knowledge of auditor, which are related to previous year financial statements, which are affecting that. So these two are called subsequent events. So we can see that. Come to the notes. The definition it is written over there. We need not to write definition here. So the events occurring between the date of financial statements, date of financial statement is year end date, and the date of auditor's report. And then the facts which become come to the knowledge of auditor after the date of audit report, they are called collectively, they both are called. So I have identified you on the timeline now. So I hope this definition is clear. Now, student, the next is subsequent events are of two types. One are called adjusting events. Other are called non-adjusting events. Adjusting event and non-adjusting event. Now, adjusting events are those events. Now, we will discuss the details of the both. For which condition of occurrence arises at or before year end. Means there was some indication present at year end, you could foresee, which has some linkage, connection, that this something wrong may happen. So they're called adjusting events. Example I will give you. For example, the company's year end is 30th June. A court case was decided against the company, and company was penalized. Penalty was charged on 15th August, 1.5 months after the year end, for a court case launched by the customer who was damaged during the year by using a product. So when the damage occurred? During the year, before 30th June. So court case was decided after year end. So a provision for this liability should be recorded. A provision for this liability should be recorded at year end. Now, in the financial statement. So it is adjusting events. Condition of occurrence exist. A customer, a receivable, which was at year end, went bankrupt on 25th July. So bankruptcy is a process, formal process adopted. So it means that it was announced on 25th July. So it means the customer was facing some problems with the cash flow at year end. So it is adjusting event. Condition of occurrence exists at year end. That's why we call it, that's why we say this over here. Yes, that they are adjusted in financial statements. These adjusting events. Financial statements are amended for their effect. They're amended, revised. That's why they're called adjusting events. Non-adjusting events, those events for which no condition of occurrence or condition of occurrence arise after year end. After year end. For example, fire erupted, an inventory damaged, property, plant, equipment damaged on 5th July, just after the year end. It has no condition of occurrence at year end. It has no condition of occurrence. Right? They are just disclosed in notes to financial statements. Their financial statements are not adjusted, not amended for their effect. Okay? Financial statements are not adjusted, not amended for their effect. Now, next. Students, let us talk about some complex examples. Restructuring. Restructuring. Implemented after year end. So, plan was complete, approved, and announced before year end or after year end. Any one of above. Any one of above these three, it was approved, announced, or after year end. So before year end, so it means it is adjusting event. If all three occurred before year end, even one single, even announced after year end, it is not adjusting. So it is adjusting event and a provision for restructuring to be recorded in financial statements. If it was announced after year end, it is a non-adjusting event. just disclosure has to be provided. Even one of these three occurred after year end. Even the plan was complete, approved before year end, only announced after year end. It is non-adjusting. Now, second complex example, dividends. So dividends declared. What is declared? Approved before year end. It is even paid after year end. Adjusting event. A liability to be recorded at year end. Dividend payable. If declared means approved finally after year end. Half process is done before year end, half done by after year end of declaration of approval. Still it is non-adjusting. Now, next point. So I hope this point is clear. Now come to the notes again. So adjusting and non-adjusting detailed examples I have talked about. So auditor's objective are that he need to check whether these adjusting events or non-adjusting events, whatever they are recorded correctly or not. They are given by the company properly or not. Okay, so come here. So this is the timeline again. Year end, same. Audit report, financial statements, and this. Students, the date of auditor's report and year end. If any events occur, auditor has to perform audit procedure and ask management to amend the financial statements. Ask management to amend the financial statements. If management does not amend the financial statements, because if they're adjusting, modify audit opinion accordingly. Because it is misstatement, maybe material, maybe pervasive. Now, students, during this time, audit report is issued. Audit report is prepared, not issued, right? And before financial statements are issued to shareholders. During this time, some facts come to the knowledge of auditor. During this time, report is prepared, audit report. Auditor asks management to amend financial statements accordingly, whatever they are. If they are adjusting, adjust it. If they are non-adjusting, disclose it. Students, yes, management adjust financial statements. Management adjust financial statement. Very good. So prepare and issue new audit report on adjusted financial statements. Yes, because no things have been changed. If management refuses to do so, then now there is There might be material misstatement. And now there are two circumstances further. Audit report with auditor. Audit report is with auditor. Audit report issued to management of company. Two possibilities are there. If it is with auditor and management is refusing to amend financial statements, modify audit opinion. Because now financial statements need amendment. Management is not doing that. So there is misstatement. So I will modify audit opinion. Maybe qualified or adverse. Now this is the worst situation. That the management is not willing to amend financial statement as per circumstances. And we have already given audit report to them. They may publish the same audit report without our permission, which is now not relevant. We issued that for the previously known circumstances. In that case, audit report issued to the management of company. So we will say over here one thing. Modify. Take steps to prevent reliance on issued audit report. What can be the steps? First of all, take legal advice. Seek legal advice. What can be done? Speak at AGM. Send a notice to shareholders if allowed by law. And the last is resign from audit. Yes. Let us proceed further. If there is any confusion, you can ask. Now, so I have explained basically this section over there. This one. Okay. All financial statements have been issued. But before AGM, any facts come to the knowledge of auditor. Financial statement issued, mean audit report also issued to the public, to the shareholder. So any facts come to the knowledge of auditor, discuss with the management. Ask them to prepare a revised financial statement. If they do, issue a new audit report with emphasis of matter paragraph, emphasizing the previous audit report was irrelevant and so on. That there is such a new matter because of which we are issuing new audit report. If they do not want to amend, prepare revised financial statements, take steps to prevent reliance on issued audit report. Yes. Now, so student, one more thing. Till the date of audit report, this year end to the audit report date. Auditor has active duty to check all events occurring. Meaning he need to plan and perform audit work on all the events, whether they have been properly reflected in financial statements or not. And afterwards, auditor has passive duty. I mean, auditor is not checking everything. Rather, whatever comes to the knowledge of auditor, passive. Okay, now, so audit procedures on subsequent events need not to memorize, just you have to, yes, review board minutes, review unusual items in the accounts, review litigation status, obtain management representation. Okay, so you have to perform these audit procedures. Okay, so that what I have explained over here, this have been given here. Okay, discuss a matter with the management, amendment. You have to read it yourself. What I have explained in the form of a table, that is given here. Now, students, just 1 minute. There is a exam kit question on it, subsequent event. It has been tested. Let me open that in front of you. We need to solve it. Just give me a few minutes, please. Scenario-based question, that is. So we need to do that today. So the question is here. Question number is 250. This is the latest, one of the latest past paper questions. Okay, we can do this as Heron Company as well. You can note down 240 as well. Heron Company, it's this part, D part. Note down for your own practice. Heron Company. That is on the subsequent events. And there is 250 as well. 249, 248, sorry, 248. Yes, this one. 6 marks. The question name is Hyacinth Company. Please go through it. I will be doing it with you people. So 6 marks, 3 marks for the first part, 3 marks for the second part. Okay. So the requirement, explain. The word is explain. You have to tell with the logic from the scenario. Apply. Explain with whether 20x5 financial statements of each company requires amendment in relation to flood. Yes. So, students, explain. Describe audit procedures, 3 marks. So let me copy it from here. Let me try to copy it from here. If I can, just a minute. No, I cannot. Okay, no worries. I will open the kit because I want to type its answer with you people. Just 1 second, please. Six marks it is. And the question, yes. This is the question in front of you. So whether it is requires amendment or not. Students, you tell me. It requires amendment or not. You tell me, what is your opinion? What do you think? It requires amendment or not? What do you think? All of you be thinking that this event occurred after the year end. It is an accident. But how to explain it? First of all, we will discuss the issue. So answer, we will start writing. So subsequent event. Yes. So how to discuss it? They say that flood occurred on 3rd June. Now, 3rd June, what was the year end? The year end is 30th April in the scenario. 30th April. Year end was 30th April. April, May, and June. So, flood occurred at companies, at a company's warehouse and damaged inventory and property, plant, and equipment. Damaged. Worth of 0.7 million value. Worth of 0.7 million value. Now, and now have zero scrap value as per finance director of company. as per finance director of company. Now, this is the issue. With a zero commentary from our side, this has no marks until unless you elaborate it with your explanation. If you call it, you say, for example, it is a non-adjusting event. But if you don't explain it how it is a non-adjusting event, you will get no marks. It is a non-adjusting event. Now, as it occurred after year end and have no condition of occurrence before year end. Yes, this is the logic. Explain. Now, students, the next point. Now we will discuss the materiality they have given. If I show you that the assets of the company total are 23.2 million, it is given. So the damaged assets are 0.7 million divided by 23.2 million is equal to 3% of total assets of company. So, and hence material to its financial statements. Being a material non-adjusting events, it needs not to be written down in financial statements because it is a non-adjusting event. Rather, a disclosure of the flood of the damage caused by flood. Rather, just a minute. A disclosure of the damage caused by flood should be given in financial statements. Yes. So it is for 3 marks. Now done. So now the second part is, you see, 1 mark is for it, materiality calculation, and it need not to be written down. And then disclosure of the damage in financial statements. Yes. Notes. It is done. Now the next is procedures to form a conclusion on amendment, on any required amendment. Now, audit procedures. related to this event. Three procedures are required. So first of all, they have said inventory and plant and equipment. Management has prepared some loss. Yes. Obtain a list of damaged property, plant, equipment, and inventory damaged by the flood. Obtain from management a list of these, okay, and verify their carrying value from non-current asset register and inventory record. Verify. Physically inspect the damaged assets to ascertain whether any scrap value can be assigned to the assets or not. Yes, discuss with management, even if it is, for example, machinery is there that is made of iron that may have some scrap value. Discuss with management the reason for their belief of zero scrap value of damaged assets and assess the validity of their response. Yeah. We have read three procedures. Now, fourth, we will write. Just one coming to my mind. In exam, you will not write more than four. Inquire from management whether all the effect of flood will be disclosed as non-adjusting event in the note to financial statements. In exam, you will write only three. Okay. So the other question which I told you, Heron Company. Yes. Let me open that in front of you. Another question. Here you go. Heron Company. Let me copy paste it. 5 marks. Yes. Here we are. Another past paper question on the same. Please read it. Then I'll proceed. The same approach. It is now 28th July, August 20x5, and the audit of Heron Company is almost complete. The auditor's report is to be signed shortly. The following matters have been brought to your attention. Now, so you see requirements are the same. Whether financial statement require amendment. So with respect to, so you should be able to understand what they're asking, amendment related to the balances. So it is about the subsequent event. Okay. And two audit procedures. Right. So receivable balance of on first 20, on 14th July, students year end is, let me find the year end date. What was the year end date from this question? Yes. The year end date is 31st May. So year end is 31st May. Okay. So, and total assets, I will write that as well for you. That is 65.4 million. And profits before tax, 8.9 million for calculation and discussion of materiality. It is 28th August now, and the audit of Heron Company is almost complete. The auditor's report is due to be signed shortly. The following matters have been brought to your attention. On 14th July, Sparrow Company, a customer of a Heron Company with a receivable balance of 692,000 at 31st May, notified Heron that it was with cash flow. On 14th July, they notified after year end and unable to pay any payment for the foreseeable future. The finance director believes that long-standing customer and outstanding amount will be received and then therefore not adjusted. Now, so students, how to discuss it? So first of all, subsequent event. The first part. Answer. The Sparrow Company, a customer of Heron Company, informed on 14th July after year end that it is facing cash flow problems and is unable to pay for foreseeable future the due balance of 692,000 is unable to pay. Yes. This communication by the Sparrow after year end means that it was in financial difficulties at year end. Yes, it was year end. and it is, and the balance from it was irrecoverable at even year end. They just have informed now to the Heron company. Yes. So condition of occurrence. So condition of occurrence of this balance to be irrecoverable arose before year end. Hence, it is an adjusting event. Now, students do not explain it properly. Utilizing, they just give a verdict, it is an adjusting event. How? How? These three lines are justifying it. Yes, I must say 3 marks are for it and 2 are for this procedure. So for 3 marks, we have to write. Okay, now materiality of the balance. Okay, the adjusting event. The balance of receivables is 692,000 divided by 64.5 million. That is equal to 65.4, sorry. Yes. 4 billion. That is equal to 1.1% of total assets and 0.692 million divided by total profit 8.9 million. That is equal to 7.8% of its profit, and hence material to financial statement of Heron Company. This amount should be written down in receivables or an allowance for receivables should be recorded of same amount by Heron Company. Yes. Otherwise. So it is basically an estimate. Otherwise, receivables of company are overstated. Yes. Now, the next point is audit procedures. Audit procedures. 2 procedures only. 2 procedures. Very easy. Recoverability. So, first of all, review correspondence. How to verify recoverability? First of all, correspondence of company, Heron Company and Sparrow Company to identify any recoverability. chances. Review the correspondence of Heron Company with Sparrow Company to assess likelihood of any recoverability of any amount due. Yes, it gives the idea, recoverable or not. Next, finance director is saying that it is not required. Adjustment. It will be received. Yes. Discuss with finance director the reason for not recording other than a long-standing customer. Other than Sparrow being a long-standing customer. Non-recording, yeah, adjustment in receivables and assess the validity of their response. Yes. Next, one more. Review post year end. You see, all these procedures are about recoverability amount. Method amendment, because finance sector is saying need not to be recorded amendment because it is recoverable. Okay, so we will see that post year end bank statement of company to identify whether any amount has been received from Sparrow Company or not. Done. You have to write only two. Any two out of these. Okay. So subsequent event topic is done. Now, so students, that's it for today. In the upcoming class, we will be covering the going concern and the questions on that as well. Okay, going concern and review, written representation. So I hope you enjoyed today's session. So see you in the next class. Till then, take care. Goodbye.